We're tracking the major averages here this morning. They're off to a good start as we begin this new trading week ahead of key inflation data out this week, which might fuel or could even constrain the rally depending upon which way the reading comes in. To discuss further, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist here with us. Keith, I want to be optimistic. I want to feel like the data is going to come in favorable of some of these potential cuts that we've been talking about. Sure, maybe not July, but September, it'd be nice to see that more firmed up a little bit. I don't know. What are you keeping close tabs on here that could sway the Fed one way or the other?
Yeah, well, first, great to be with you, Brad and Sean. I hope you all had a great 4th of July extended weekend. So thinking ahead, the way we're thinking about the overall picture right now is the Fed is likely to cut rates in September. We see an economy that is cooling. We wouldn't call it weak, but it is cooling. And we're seeing those inflationary trends also cool somewhat. So we think it's going to be time for the Fed to start moving. And we expect 1 to 2 Fed cuts this year. And that actually continues. What we're starting to see is a slow but global easing cycle. You put that together with profits that are still moving forward. We still think that's a positive environment for stocks, but again, probably not at the same pace that we saw in the first half.
So then, Keith, what do you think the gains then would potentially, if the movement then is still to the upside, it seems like that trend is intact. What do you think that maybe the gains more realistically look like from here?
Yeah, I think realistically, somewhere in the 5 to 10% range, we could still see that. If we look at, instead of what I think, the historical data as a starting point, we've seen 27 times historically where the market has had a 10% plus first half. If you look at the second half, you tend to add to gains, or you've seen gains added 24 of those 27 times, so 89%. So that's a pretty good hit rate. The average gain has been about 9%. But here's one important stat, too. In that back half, the average peak to trough decline, meaning at some point you have a hiccup, is also around 9%. So we think the trend is higher, but we do think we'll see 1 or 2 pullbacks along the way. And again, the main support should be fundamentally earnings moving forward.
Keith, where does tech fit into all this? Because you had been bullish on tech for many months at this point. Recently, though, downgrading it to more of a neutral holding. I'm curious then what that tells us about maybe the concentration. Are we going to see broader participation, and how investors should be viewing tech at this point?
Yeah, it's a good point. We were overweight tech since last November, and then in late June, we actually downgraded it to a market rate. So again, not a bet against tech, but it's saying, hey, we just had one of its, we're up over 30% this year, over 40% since we upgraded it in November. We saw in last month, the relative performance in late June became the most on a 1-month basis in about 20 years. So our main message to our clients was like, listen, we still like tech. We don't think this is a bubble longer term, but on a short-term basis, we're getting a little bit overheated, a bit stretched, and we just think there will be a better opportunity to redeploy capital there in a more meaningful way. But what that means for the overall market, if the tech is such a big part of the overall market, we think as we get maybe towards the back half of July, maybe some more chop and some digestion, maybe some rotation within the market. What's interesting, Sean, is you're also seeing rotation within the Mag 7 itself, but I do think we'll see some of that rotation and maybe more of a choppier market as we head into late July into August.
Which sector is the biggest beneficiary of rotation at this juncture, Keith?
Yeah, it's a tough call because in our sector work right now, we only have 2 sector overweights, which is still communication services, which is still tech oriented. And then we have something, utilities, which is more defensive, maybe a little bit of an AI play, but also which should be supported by lower yields. I think it's more like what's going to happen is you're going to just see maybe not things standing up, but maybe a little bit of money going to financials, industrials, energy. It's just kind of a little bit of a rotation into other areas. And then I think later in the year, I think money will come back to tech, and we'll be looking at potentially upgrading it. But we're going to be patient for that opportunity to present itself.
Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, thanks so much again for joining us here.
Great to be with you.